When mutual funds, MFs, increase participation in IPOs despite volatile secondary markets, it most likely reflects which investment behavior? Your options are: A. Herding bias among institutional investors. B. Sector rotation based on defensive repositioning. C. Strategic allocation toward primary markets to exploit listing inefficiency. D. Contrarian investing to capture undervalued secondary stocks. And the correct answer is option C. Strategic allocation toward primary markets to exploit listing inefficiency. Anchor investors like mutual funds influence IPO pricing primarily by: your options are: A. Fixing the final issue price through direct voting. B. Acting as reference buyers signaling confidence and setting valuation benchmarks. C. Providing debt guarantees to underwriters. D. Enforcing lock-in extensions for QIBs. And the correct answer is option B. Acting as reference buyers signaling confidence and setting valuation benchmarks. Sunny Agrawal's caution on fair to expensive valuations indicates IPOs may be approaching which stage of market efficiency? Your options are: A. Weak form inefficiency. B. Semi-strong form efficiency. C. Overvaluation phase of behavioral mispricing. D. Arbitrage-free equilibrium. And the correct answer is option C. Overvaluation phase of behavioral mispricing. Increased MF participation in IPOs despite tepid short-term returns suggests a shift toward which investment style? Your options are: A. Growth investing. B. Tactical momentum-based allocation. C. Long-term fundamental value alignment. D. Event-driven arbitrage. And the correct answer is option C. Long-term fundamental value alignment. Flush with funds due to steady SIP inflows gives MFs what structural advantage in IPO participation? Your options are: A. Ability to arbitrage between primary and secondary prices. B. High liquidity buffers enabling flexible deployment without redemption risk. C. Reduced portfolio concentration risk. D. Enhanced fiscal leverage for margin trading. And the correct answer is option B. High liquidity buffers enabling flexible deployment without redemption risk. Mutual funds acting as anchor investors enhance corporate governance because: your options are: A. They ensure post-listing price stability through continuous buying. B. Their due diligence and pricing discipline impose credibility and transparency. C. They represent regulatory authority oversight. D. They control retail investor participation limits. And the correct answer is option B. Their due diligence and pricing discipline impose credibility and transparency. Retail investors often follow MFs into IPOs assuming institutional wisdom. This reflects which behavioral bias? Your options are: A. Confirmation bias. B. Representativeness heuristic. C. Authority bias. D. Anchoring bias. And the correct answer is option C. Authority bias. The surge from 15 IPOs to 46 in a quarter most directly illustrates which market dynamic? Your options are: A. Crowding out effect in secondary markets. B. Supply-side expansion driven by favorable liquidity and investor sentiment. C. Fiscal contraction cycle in monetary policy. D. Structural deleveraging of corporates. And the correct answer is option B. Supply-side expansion driven by favorable liquidity and investor sentiment. QIB anchor investments carry a 30 and 90-day lock-in. This structure primarily aims to: your options are: A. Increase underwriter commissions. B. Prevent speculative flipping and ensure price discovery stability. C. Reduce fund manager risk appetite. D. Boost retail oversubscription probability. And the correct answer is option B. Prevent speculative flipping and ensure price discovery stability. Prithvi Haldia's observation that MFs now write large checks and set IPO price signifies which macro evolution in India's financial ecosystem? Your options are A. Shift from bank-led to market-led capital formation. B. Fiscal dominance of sovereign wealth funds. C. Reduction in FPI, foreign portfolio investor, participation. D. Replacement of merchant banks by AMC boards. And the correct answer is option A. Shift from bank-led to market-led capital formation.